Ladies and gentlemen, good day and welcome to AWFIS Space Solutions Limited Q4 and full year FY24 earnings conference call hosted by IIFL Securities Limited. This conference call may contain forward-looking statements about the company which are based on the beliefs, opinions and expectations of the company as on date of this call. These statements are not the guarantees of future performance and involve risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Amit Ramani, Chairman and Managing Director from AWFIS Space Solutions Limited. Thank you, and over to you, sir.
Good morning and a very warm welcome to everyone present on the call. Along with me, I have Mr. Sumit Lakhani, our Deputy CEO, Mr. Ravi Dugar, our Chief Financial Officer, and SGA, our Investor Relation Advisors. To begin with, I'd like to thank and congratulate all our stakeholders, investment bankers, and business partners for helping us achieve a milestone of getting listed on the Indian stock exchanges. We were delighted to see such a strong response to our IPO. Since this is our maiden earnings call, I would like to take you through AWFIS Space Solutions' journey so far, broad industry update and strategies going forward, followed by our operational and financial highlights for quarter and the full year ended FY24. Post that, we will open the floor for Q&A. We have also uploaded our investor presentation on stock exchanges, and I hope everybody had a chance to go through the same. AWFIS started its business in 2015 and has since emerged as one of the leading flexible workplace solutions company in India with network leadership. We identified 3 deficiencies in the Indian commercial real estate service sector, which we aim to address by offering a comprehensive range of flexible workplace solutions tailored to meet the need of our various clients, from individual freelancers to large multinational corporations. AWFIS services include everything from individual flexible desk options to fully customized office spaces designed for startups, SMEs, and large corporates. The first aspect we focused on was transparency in pricing and tenure for office spaces. We realized that businesses often struggled with inconsistent pricing models and rigid lease terms. AWFIS Space Solutions are highly adaptable, catering to diverse range of seat requirements. Clients can book anything from a single seat to multiple seats with flexible contracting periods that span from as short as 1 hour to several years. This flexibility allows AWFIS to meet the dynamic and evolving need of modern businesses. Over the years, AWFIS has transitioned from being merely a co-working space provider to an integrated workplace solutions platform, offering a broader array of services and solutions. The second aspect was creating more accessibility to workspace options. We understood that companies needed office spaces in a variety of locations, including diverse micro markets, to meet their unique operational needs. Therefore, we expanded our footprint to ensure that businesses could find suitable office spaces in different parts of the city, thereby enhancing their ability to operate efficiently and conveniently. The company's presence is widespread, encompassing all Tier 1 cities and 7 Tier 2 cities across India. In total, AWFIS operates in 17 cities, 53 micro markets within the country. As of March 2024, AWFIS has 181 centers across 17 cities, totaling 110,540 seats. The company's total chargeable area amounts to 5.56 million square feet. Currently, 21 of these centers, offering about 15,500 seats, are under fit-out. The third aspect we addressed was flexibility. We recognize that businesses require flexible workplace solutions that can adapt to their changing needs. Our model allows clients to lease spaces for varying durations from short-term to long-term, from small offices to larger workspaces. Moreover, clients have the flexibility to upscale or downsize their space as their business needs evolve. We provide 3 primary services. Our core offering is space solutions encompassing co-working solutions tailored for our clients seeking flexible workspace options available by the day, week, month, or a year, with a seat pricing structure that an enterprise solution customized for business needing tailored office setup, with fees based on service scope and client specifications. Additionally, we offer allied services like meeting rooms, day passes, ideal for temporary workspace needs, virtual office plus solutions, which provide businesses location addresses and package handling services. Another service we offer is Office Transform, providing comprehensive design and build solutions for developing our centers as well as assisting in development of external commercial offices for our clients. And lastly, we have Office Care, through which we provide end-to-end property and facility management services for clients at their conventional offices. Office is the only platform across the globe which provides complete integrated services of the CRE needs with great cross-selling opportunities across our service segments. Now coming to our supply side of our business, we have a differentiated model for sourcing and procuring workspace. First, the straight lease model, and second is the managed aggregation model. Under the straight lease model, we typically enter into arrangements for a period of 5 to 9 years, and the capital expenditure for fitting out the property is entirely borne by office. Under the straight lease model, the risk of capital occupancy buildup and pre-operative operational burn is borne by office, turning out to be a capex-heavy model. Under the managed aggregation model, our agreements are structured on a profit or revenue sharing model, making it risk-averse, and capital of fit-outs is largely being borne by the space owner, making the whole model capital light. We typically provide a minimum guarantee to the space owner, payable generally starting anywhere from 5th to 13th month of operation until the end of term of the contract. As of March 31, 2024, the minimum guarantee at the company's managed aggregation center was at an average of 46% of that micro market rental. Over the years, we have increased our focus on lower risk, asset-light managed aggregation model, and as of March 31, 2024, 64% of our centers are in the managed aggregation model. We have increased the percentage of seats under the managed aggregation model from 46% in FY21 to 66% in FY24. We have the largest number of centers under the managed aggregation model among the organized workplace players as of March 31, 2024. The managed aggregation model allows for significant improvements in return ratios. Due to the increasing share of managed aggregation in our total portfolio of 181 centers, this asset-light strategy will continue to enable us to rapidly scale our business, expand our footprint, and without being subjected to any high capital investment costs. The fixed lease rental payment obligation resulting in high return on capital employed. So these two structures will help expand a capital light model and will diversify our risk. While the MA model continues to be a key part of our supply strategy, we enter into straight lease arrangements primarily when it aligns with our strategic interest or client demand is clearly identified in advance. For instance, we may enter into arrangements under SM model in prime locations where our brand presence is crucial or when a client demand is already established in a certain site or a micro market. At Office, we will continue to prioritize investments with sharp focus on return on capital employed. Let me spend a little bit of time on the industry. Our industry has witnessed accelerated demand post the pandemic. The penetration level of flexible workspace sector in the office space, non-SEZ segment, has seen a steep jump from 9% in 2020 to 12.5% in December 2023. This is expected to rise to 16% on the expanded base in 2026, which means that 1 in 6 leases across the country will be in a flexible workspace model. The demand for seats in flexible workspaces has been continuously increasing in the last 3 to 4 years and growing at an average annual growth rate of 30 to 40% from 2019 to 21. The year-on-year seat take-up is increasing at a CAGR of approximately 42% from approximately 59,000 to 69,000 seats per year in 2019 to 1,67,000 seats to 1,77,000 seats per year in 2022, and expected to reach 3,35,000 seats to 3,45,000 seats per year by 2026. IT technology and software development sectors have been the major demand drivers for flexible workspace in the last 3 to 4 years, followed by banking, financial services, and insurance, which has witnessed an increase in demand for space from flexible workspace operators over the years. In addition, according to the CBRE report, the market size of flexible workspace segment has more than tripled in last 3 to 4 years from 20 million square feet before 2019 to approximately 62 million square feet as on December 31, 2023 in Tier 1 cities, and approximately a total of 1.7 million square feet in 2019 to 5.7 million square feet as of December 31, 2023 in Tier 2 cities. The total projected market size in Tier 1 and Tier 2 cities for flexible workspace segment is projected to be approximately 105 million square feet by 2026. We recently concluded our IPO of 599 crores through a combination of fresh issue of 129 crores and an offer for sale of 471 crores by selling shareholders. We propose to utilize the net proceeds from fresh issue towards funding capital expenditure towards establishment of new centers, funding our working capital requirements, and general corporate purposes. Office has been a continuous recipient of awards and accolades. We received the Best Co-working Brand of the Year at Economic Times Real Estate Conclave in 2024, received the Co-working Brand of the Year award at Realty Plus Flex Spaces Conclave and Excellence Awards in 2024, received the Managed Spaces Design of the Year award at Realty Plus Flex Space Conclave and Excellence Awards in 2024. Let me conclude by saying that we strongly believe the co-working industry is at an interesting junction. With increased investment in India by MNCs, continuous growth of large corporates and SMEs, and startup ecosystem, we are confident to strengthen our leadership position in flexible workspace segment in India. Let me give you a brief on our future growth strategy. Point number 1, continue to build on industry-leading capital-efficient model. This is where our managed aggregation model will come in focus, because as the share of the business through MA model increases, it will have a positive impact on our return ratios and thereby on our ability to scale the business. Point number 2, expand in new and existing markets. Our approach will be to have a controlled and methodical expansion of markets. We will continue to invest in markets where we believe there are strong returns in long term. Our experience of last many years, coupled with strong understanding of our client needs, we will also make strategic early investments in Tier 2 cities. Point number 3, enhance our product and service offering by applying our understanding of client needs and increasing focus on office transform, office care, and allied services. Our efforts will also be geared towards widening the range of clients we cater to. Point number 4 is to improve operational efficiency. Here we will build a strong vendor base, leverage on technological tools, and improve employee learning and development. Let me now hand over the call to Mr. Sumit Lakhani, our Deputy CEO, to share Q4 operational highlights and guidance for FY25. Over to you, Sumit.
Thanks, Amit. Good morning, everyone, and a very warm welcome to everyone. Let me give you a quick overview on our performance. We ended FY24 with a revenue from operations of rupees 849 crores, registering a growth of 56% on year-on-year basis. For Q4, we registered a growth of 46% on year-on-year basis and reported revenue from operations of rupees 232 crores. In FY24, 73% of the revenues came from the co-working space on rent and allied services, 24% from construction and fit-out projects, and the balance from others. On absolute basis, for FY24, we witnessed 48% year-on-year growth in co-working space, 95% from construction and fit-out projects, and 17% growth in rest of the business. Our revenue base is extremely diversified. Top 5 clients contributed 13.8% to space revenues, while the largest client stood at 4.9% share. Based on number of occupied seats, approximately 68% of client base belongs to large corporates or multinational companies, approximately 20% to small and medium enterprises, and 11% to startups, and the rest to freelancers. We cater to all seat cohorts ranging from a single seat to multiple seats. Our cohort of over 100 seats has been steadily increasing, and now it stands to 48% in FY24, from 50% in FY21 to 58% in FY24, demonstrating the growing confidence of our clients with larger cohorts in us. An important metric in our business is the weighted average total tenure and weighted average lock-in tenure on the basis of seat cohorts. This metric indicates the revenue visibility in our business. Currently, total weighted average tenure of the portfolio is approximately 33 months, while the total weighted average lock-in tenure is at 24 months. These two metrics are steadily increasing. Our multi-channel approach of engaging real estate brokerages, digital media, advertising strategies, and our in-house team, coupled with strategically located centers and a high-quality product, allows us to be at these healthy levels for total tenure and lock-in tenure at a portfolio level. As a commercial real estate player, occupancy levels are an important metric to assess the utilization level and plan future capex in our business. Currently, the overall or blended occupancy levels are at 71%. Within this, it is important to note that the occupancy levels increase gradually as we launch a center. For instance, 85% of the centers launched since fiscal 2022 crossed 80% occupancy within 7.5 months of starting operations. Occupancy levels for centers with more than 12 months of operation stood at 84%. This explains the strong client sourcing practices at office, while also validates the selection of micro market and within micro market a specific office complex. We manage demand for our services by employing various renewal and churn management strategies. For instance, we actively monitor our renewals through our expiry 90 tool that gives us insight to forecast and monitor renewal of our clients during the next 90 days, thereby enabling us to plan efficiently in advance for vacancies at our centers. In terms of operational highlights for the quarter, operational number of centers increased from 119 in financial year 23 to 160, with an additional 21 centers under fit-outs and totaling to 181 centers in FY24. For FY23, operational seats stood at 68,203. During the year, we added 27,490 operational seats, 15,510 seats are under fit-outs, making the total seat count for FY24 at 110,540. We have also signed LOI for 16,522 seats. Overall, operational centers and seats grew by 35% and 39% respectively from FY23 to FY24. During the year, we sold 36,857 new seats, and for Q4 FY24, about 9,000 seats were sold. For FY24, 66% of seats under managed aggregation model driving capital efficiencies for the business. Average monthly churn rate stood at 1.2% for FY24. As of March 24, we served a marquee customer base of 2,459 unique clients. In terms of new openings during the quarter, 22 new centers were launched with 73% centers under managed aggregation model, and 15,084 new seats were added with 69% seats in managed aggregation model. In terms of new openings during the year, 43 new centers were launched with 79 centers under managed aggregation model, and 27,490 new seats were added with 79% seats in managed aggregation model. Overall, 86% of the supply addition was in Tier 1 cities. So, from a FY25 guidance perspective, as you can see, currently we have approximately 95,000 operational seats. We plan to add around approximately 40,000 new seats in FY25, reaching a total of approximately 135,000 seats by end of FY25. As you would have observed, that as of March 24, we already have approximately 15,500 seats under fit-outs, and for approximately 16,500 seats, we have signed LOI in place, so we have good comfort of delivering this growth. The supply team is continuing to engage with space owners for new supply opportunities. This is the supply growth and the increase in occupancy across our existing operational centers, we expect to grow our revenue by 30% in FY25. Due to an increase in occupancy and operating leverage on cost, we should be able to improve our EBITDA margins by approximately 1.5% for FY25 versus FY24. Business will continue to see higher ROCEs at higher level, at level higher than FY24. This is all from my end. I now invite Ravi, our CFO, for the financial discussion.
Thank you, Sumit. Good morning, everyone, and a very warm welcome to everyone. Let me give you a quick overview on our financial performance. For FY24, our consolidated revenues from operations stood at 849 CR, a growth of 56% on a Y-on-Y basis. The EBITDA stood at 271 crores, which is a growth of 54% on a year-on-year basis. The margins stood at 31% for FY24 and at 31.5% for Q4 of FY24. The depreciation charge for financial year 24 stood at 196 crores. Out of this, rupees 55 crores was related to fixed assets depreciation, and the balance 141 crores was related to lease rentals accounting under Ind AS 116. Similarly, finance cost for financial year 24 stood at rupees 93 crores. Out of this, rupees 4 crores was related to borrowings and other finance charges, and the balance 89 crores was related to lease rentals accounting under Ind AS 116. For FY24, our cash EBIT, which is EBITDA less the actual lease payments, stood at rupees 97 crores, which is a growth of 168% on YOY basis, and was rupees 36 crores in FY23. We are a PAT positive company in Q4 of FY24, and the loss of our company has reduced from rupees 47 crores to rupees 18 crores in FY24, which is a significant improvement in the performance of the company, driven by higher revenue and operating efficiencies. As you would know that Ind AS accounting EBITDA, under Ind AS accounting, EBITDA does not include rental payments. Therefore, to give a complete clarity, we are also sharing Ind AS 116 adjusted estimates. This is in a way equivalent to IGAAP accounting adjusted for lease accounting. On Ind AS 116 adjusted basis, the EBITDA has improved to 10.4% in FY24 against a 4.3% in FY23 on the back of strong revenue growth and operating efficiencies. Correspondingly, PBT has improved to 2.3% in FY24 against negative 3.9% in FY23. For Q4 of FY24, EBITDA has improved to 11.7% against a 3.2% of Q4 of last year, FY23, again on the back of a strong revenue growth and operating efficiencies. On a full year basis, on a full year Ind AS adjusted, if we have to further do an equivalent IGAAP, Ind AS to IGAAP accounting adjustments, the impact would be around 5.8 CR, largely coming from other Ind AS adjustments, namely 109, which is on financial instruments, and 102, which is on share-based accounting payments. As a result, an equivalent to EBITDA number would be around 96.8 CR. Our debt at consolidated level stood at rupees 32 crores. Gross debt to equity is at 0.13. At the net level, we are a debt-free company, and net debt to equity ratio is at minus 0.1. With IPO monies coming in and further improvement in profitability, we further expect to cement our position in the market and continue with our growth aspirations. Our ROCE stood at 43% for financial year 24, and on an annualized basis, it is at 53% for Q4 FY24. Operating cash flows for FY24 stood at 228 crores, and accordingly, OCF to EBITDA stood at 84%, which indicates a very healthy cash conversion ratio. Our CapEx spends, excluding the right of use assets of FY24, stood at 142 crores, while for FY25, we expect CapEx spends in a very similar range. This again will be a function of the mix/split between MA and SL. In our business, it is important to measure us on an annualized basis. We say this because there could be additions in capacity in specific quarters, leading to upfront investments in infrastructure, manpower due to new centers rollout or expansion in network, which may have a short-term impact on margins. As we have showcased our occupancy levels trend improving by end of year, we expect margins to move up and get benefit of operating leverage. Having said this, as Sumit mentioned, we are confident to deliver a margin improvement on an annualized basis of approximately 1.5% in FY25 over FY24. This is all from our end. We now open the floor for Q&A.
Thank you very much, sir. We will now begin the question and answer session. Anyone who wishes to ask questions may press star and one on their touchtone phone. If you wish to withdraw yourself from the question queue, you may press star and two. Participants are requested to use only handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Mohit Agrawal from IIFL Securities. Please go ahead.
Yeah, thanks for the opportunity and congratulations to the entire team on the listing. My first question is on managed aggregation model. So it's a longish question. So how do you see in this 40,000 seats guidance that you have given for FY25, is the mix of managed aggregation and SL going to be in the same 2/3, 1/3 ratio? And do you see any challenges, in terms of supply being a challenge in expanding under the managed aggregation model, especially considering, from a landlord perspective, because they need to put in the capex. And lastly, on this would be, in general, do you see the industry moving towards the managed aggregation model? You've mentioned that you're the largest player, so some color on that, considering that this is pretty ROC accretive. So your thoughts on that?
Thanks, Mohit, for the wishes, and thank you for the question. Your first question was around the split. Our endeavor would be to continue the split as we have been able to achieve, which is approximately 65 to 68% of MA, managed aggregation, and the rest being straight lease. So we'll continue in that model. Second, you said about sourcing supply. So Mohit, clearly, I think it's been a journey over the last 9 years. Clearly, when we position the managed aggregation model to the landlords, it seems a bit tough to start with. But clearly now us having presence in, approximately 17 cities today, 53 micro markets. In addition, today, if you look at it, out of the total 180 odd centers, almost 120 centers are in managed aggregation, and this is across tier 1 and tier 2 cities. So we have proven ourselves as, one of the best in class when it comes to partnering with our landlords and delivering returns. And we have also developed a very strong network of our both international property consultants and domestic property brokers, almost close to about 350 to 400 across India. That acts as our extended partners to help source that supply. So to answer the question in a nutshell, with the brand we have, with the credibility we have built, with the returns we have delivered to our landlords, we don't foresee any challenges. To your final question on will the other people in the industry look at it? Well, the reality today, Mohit, is that, we are the largest. We do, as I said, almost 66% of our portfolio is in MA. We are the proven entity. Will other landlords partner with other operators? I'm sure they will. But clearly, we are on this journey. Sumit outlined the growth that we have for this year, close to about 40-odd thousand seats, out of which almost 65+% is going to be in MA model. So clearly, we have a leg up on everybody else in the industry. When you want to partner with a brand, you will go with the largest proven brand, usually in this kind of model, versus taking a bet with somebody entering new. So I hope I answered your question.
Yeah, sure. My second question is about, you mentioned in your opening remarks about making investments in tier 2 cities. So what kind of opportunity do you see there in terms of exposure? Where do you want to see, like, let's say, number of seats or revenue? What kind of opportunity do you see in the next 2 to 3 years? And what is also, if you could give some color on the kind of clients you would see there, will it be a similar mix like you have mentioned about corporate MNCs having about 68% of your demand? So would it be similar in the tier 2 markets as well?
So, Mohit, we were the first ones to expand into tier 2 cities. Our first city was Chandigarh in 2018. And